5 ways to bypass or lower taxes on capital gains. What's up, y'all? It's Prince Donnell, founder of the Jumping Jack Tax franchise, where we offer taxes, life insurance, bookkeeping, and other financial services to fulfill your needs. I appreciate you for watching this video yet again. If you are an avid subscriber, first and foremost, I want to thank all of the subscribers on YouTube. We have been growing. We're at about 76K right now. Our goal is to get to 100K. So if you value this video, please like, comment, and subscribe. And all of my stock market investors, y'all are going to like this video. If you're a beginner stock market investor that you don't understand what capital gains are, short term, long term, and how to bypass those taxes, this will be very valuable for you. And I'm gonna bring some game, and if this is of massive value, the only thing that I ask in return of you watching this video is to support my business, right? Support my franchise. So you found value in this. We offer personal and business taxes, life insurance, bookkeeping. You can shoot a text message, text info to 267-792-0185. And I would love for my company and the professionals to be able to assist you tax wise or any other financial services that you have. Right. So let's go ahead and get into it. This is a quick video, and I want to just get a really nice breakdown for you so that you know how to operate when moving and buying assets. And in this example, I'm going to give I'll be talking about the stock market, since this is the one that I'm most active in, and odds are you are too. Let's start off by talking about what is a capital gain. For all of the beginners who may not have ever invested in the stock market or have had assets before, you don't know what a capital gain is. Basically, a capital gain occurs when you sell an asset for more than you paid for it, right? And that has to do with stock market, stocks, bonds, real estate. It could be cars, it could be boats and other assets that you acquire and you sell them for higher than what you bought it for. And you could go to the IRS website as well, and they'll have a list of all the different assets that are subject to capital gains and capital gains tax, so that you know, because some assets are taxed differently than others. So it's important to understand that. But the purpose of this video is for you to understand, if I sell my asset for more than I paid for it, then it's possible that I'm going to have to pay capital gains tax on that asset. So the formula that I like to use is capital gain equals my selling price minus my purchase price, right? Let's put the formula here on the screen. Capital gains equals my selling price minus my purchase price. And that's how you'll always know what that capital gain will be, so that if it's subject to tax, you know what you'll have to pay. So let's use an example of a real life scenario that happened to me, and we'll use that example in the stock market. So back in about June 2020, I think right around April to June, this was when the pandemic happened, and obviously the stock market was at a discount, meaning that a lot of stocks, a lot of company stocks were undervalued, right? So you'd be able to buy up, a lot of shares, and at that time, I ended up finding Fiverr, and Fiverr at the time, I would spend money with Fiverr all the time. So a good example of, buying companies in the stock market, I think a great first example that I've learned from a lot of other people who are massively successful in this is, start off by buying things that you're already spending money on right now, right? And having ownership of those stocks in those companies. And Fiverr was one of them. When it came to business, I would get websites done there, graphics, all types of stuff. Like I would spend thousands of dollars in them in a year. And also I'm like, damn, especially during the pandemic, one would think, or one would speculate that, obviously, a lot of people are going to be doing side work, and you would think that people who are doing graphics and websites and different things of that nature, that's going to be a big business because everybody's doing it from home and side work. So I'm like, damn, you know what? I want to buy into Fiverr, man, have ownership in the company. And at the time, I ended up getting it in June 2020 for $68 a share. So I bought about 30 shares at $68, right? And that was a total of $2,040 price point to be able to acquire all 30 of those shares. Should have got more, but that's a whole nother story. So it was $2,040 total price that I ended up getting it. And right around February 2021, February 8th, 2021 to be exact, I ended up selling because the stock price ran up to $268. and I sold it right at 268 price point. And so I sold at 268 on February the 8th. So remember when we talk about the formula, right? Capital gain equals my sell price minus my purchase price. So let's just give that example. Well, I know if my sell price was 268 and my purchase price was 68, then my capital gain was $200 per share. And of course, since I had 30 shares, now you just obviously do multiplication. $200 at 30 shares now, that's a $6,000 capital gain that now occurred, right? $6,000 capital gain from holding in all the way up until February. We're not going to get into the tax yet, but as y'all see on that scenario, that's how you can calculate now what your capital gain is. Like I said, let's 68 went up to 268. $268 sell price minus $68 purchase price, $200 capital gain. Multiply that by how many shares you have. Boom. You now have your capital gain. Now, at this point, it's important when we talk about capital gains for those who are, again, beginners. Let's talk about how you're taxed, right? Because now that I have a $6,000 capital gain, it's important to know the difference between short-term and long-term capital gains, because it's going to be a difference in how much taxes that you owe. Let's say on that $6,000 that I now have as a capital gain, that's now realized, right? So let's break down how taxes work when you actually sell. So I think it's important to back up a little bit first. And it's important to realize that before we talk about short-term and long-term capital gains tax, there's a difference between an unrealized capital gain and a realized capital gain, right? So between that time of June 2020 all the way up to February, obviously the stock price was increasing, which means that I was making money, but I was making money on paper. But since I didn't sell, that's considered an unrealized capital gain, meaning that I never have to pay tax on the growth of that stock until I actually sell and it becomes realized. So to give you a better example of that, we see a lot of times people like Jeff Bezos and the founder of Tesla, Elon Musk, and you see these and Mark Zuckerberg with Facebook. We saw them making billions of dollars over the pandemic, right? They were making so much money, billions, and people were like upset because they're like, "Yo, how did their net worth increase by billions, but yet they're not even paying that much in taxes based on how much their net worth," right? Well, it's important to understand that although their value increased in billions, it's because of the amount of shares that they own in their company, right? Like I think Jeff Bezos has like 17% share in Amazon. So based off of all those shares that he owns, when Amazon's stock price increased, then of course his net worth increases at the same time. But until Jeff Bezos actually sells off his shares, right, for cash, until he sells them off, he doesn't have to pay taxes. It's unrealized. So his net worth continues to grow, but he doesn't owe any taxes. So it's important to understand that as everyday people, that when you're an investor, as long as you don't sell, yeah, you're getting richer on paper. Obviously, you don't have the cash, but there are ways around that too. So know the difference between unrealized and realized. I never have to pay tax if I don't sell off that asset, that stock, right? As long as I hold it, I'm good to go, which is one of the things we'll talk about later on in this video. So when I sold, that now became a realized capital gain where now I potentially have to pay tax on that gain. So now let's talk about short-term and long-term capital gains tax. Now that it is realized, I have a realized $6,000 gain. Okay. So short-term capital gains tax, that $6,000 that I now have as a capital gain. It's short-term capital gain tax if I sold less than a year, which indeed I did, because I told you guys I bought in June 2020. I sold in February 2021. The reason why and I'll talk about that in a second, but I'm now subject to short-term capital gains tax because I didn't hold for longer than 365 days. So with that now, short-term capital gains tax is your ordinary income tax. So let's give an example. And this is important because the ordinary tax rate is so much higher. ordinary tax can go up to 37% based on your tax bracket. So as an example of that, let's say that for the year, I ended up, after standard deductions and other type of deductions that I qualify for, let's say that my adjusted gross income for the year was $100,000. So if I have $100,000, if I made $100,000 for that year, let's say that my tax bracket, I think it's 24%, then I'm going to end up having to pay 24% on that $6,000 because it's short-term capital gains tax on my ordinary tax rate. So that's expensive. Imagine if your adjusted gross income was upwards of $400,000 plus dollars, you could be paying close to 37% in tax on that $6,000 that you just now had as a realized capital gain. That's expensive. That's almost half of the money. You be paying close to $3,000, right? That's huge. So if you sell less than a year, you're going to be paying ordinary capital gains tax on every single time that you sell for less than a year, right? So for me, it's about, let's say 24% if my adjusted gross income is $100,000 for that year, right? 24. Now, on the flip side, if I held for longer than 365 days, let's say I held for 366 days, now I'm only paying long-term capital gains tax, which is much cheaper because long-term capital gains tax, you're paying anywhere from 0 to 20%. So if my adjusted gross income is, I think, $41,000 or less, I actually don't have to pay any tax. It's 0, right? And then if I don't have the brackets, we could put the brackets up here on the screen. But based off of let's use the same example that if my adjusted gross income was $100,000 for that year, then I'm going to end up paying 15% long-term capital gains tax. But let's think about it. I'm paying 15% long term as opposed to 24%, which is an extra 9% roughly that I'm paying in taxes, right? That I'm able to save just because I held for longer than 365 days. So with that being said, because I'm about to roll into the 5 ways that you can bypass or lower your taxes, I'm about to run into that in 1 second. If y'all keep watching here, with that, one of the things to just literally lower the amount of taxes you owe is by literally holding for 366 days. That is going to save your life right there by saving money. A lot of people don't want to hold, right? And they don't want to buy and hold. So that was it. And really the main reason why I didn't buy and hold Fiverr to begin with was because of the fact that obviously when I was looking at the chart, I just noticed that, obviously the RSI was a little hot and I realized that the stock was on a run and it was about to take a dip any minute. And I sold right at the top before it took that dip, because literally right after I sold stock, I think the stock price ended up dropping from 268 all the way down to, I think it was the low 200s. So I ended up catching it at the right time. It was the perfect trade. But, sometimes you got to think about that as well. I took my profits at the top, which is nothing wrong with that. But just remember, if it's less than a year, you're going to have to pay short-term capital gains tax. If it's longer than a year, then you pay long-term, which ends up being cheaper from a tax perspective. With that being said, now that we understand what capital gains are, we understand the formula on how to get your capital gain, and we know the difference between short-term and long-term capital gains tax. Let's now go into the 5 ways that you can lower or bypass taxes altogether on your capital gains. So let's go into number 1 to recap off of what I was just talking about. Buy and hold. Say it with me, ladies and gentlemen. Buy and hold. Let's say it one more time. Buy and hold. Right? When you buy and hold for at least 365 days, you are lowering the amount of taxes that you owe, because you're going to be subject to long-term capital gains tax of 0 to 20%, as opposed to ordinary tax, which can go all the way up to 37%, depending upon your adjusted gross income. Buy and hold. Not to mention, buying and holding is the most effective way to double and triple your income and your net worth. But on top of that, that's how you create generational wealth, through buying and holding, right? So you hold for a longer period of time, then you have no issues, right? So number one, buy and hold. Number two, invest through an IRA. And if we're talking about the stock market right now, yes, preferably I love a Roth IRA. I love it. I'm not going to get into all of the nuts and bolts of what a Roth IRA is. I'll do that in another video. But just to simplify this, I currently have a Roth IRA and I had to set it up as a backdoor Roth IRA because IRAs have income limitations in order to have one. It's like $100 and something thousand, but there's a way to get around it through having a backdoor Roth IRA, and you can still set one up. And when I did, basically now with that IRA, I can contribute up to $6,000 in a year to that IRA, to that Roth IRA. And these are after-tax dollars that I'm putting into the Roth. But here's the beauty of it. When I'm investing into quality companies and index funds through this Roth IRA, then all of the gains that I am earning in this Roth IRA, when I turn 59 and a half and I now have the ability of accessing those funds without getting penalized now, I don't have to pay any taxes on the gains. When I'm 59 and a half, let's say that my Roth IRA ran up $1 million in gains, right? Just through me long term, and I'm doing it year over year now from the age of 27 all the way up. And now I ran up $1 million in capital gains through buying and holding. Now at 59 and a half, when I go to access those funds, if I want to access the funds, I don't got to pay any taxes. That's the beauty of having a Roth IRA, right? No taxes when I'm 59 and a half because I contributed to it with after-tax dollars. So that's a way right there to be able to bypass the taxes altogether through establishing a Roth IRA. So if you're watching this right now, I encourage you to go ahead and open up that Roth IRA. Have a 401k established with your job. Have a traditional IRA. It all depends. Obviously, you want to do your research. You want to look and talk to a professional, but it's important that you set up a retirement account. That's an effective way to lower your taxable, your capital gains or bypass it altogether. And number three, you can use your capital losses to offset your gains. Basically what that means is this, right? Let's say with the same example with Fiverr, boom, I know that I'm about to sell on February 8th, right? And because I want to get rid of it because I believe it's about to drop, and I go ahead and sell. Well, in that same year, what I can do is if I know I have a $6,000 capital gain now, I can look at some of the losing stocks that I have and I can sell off the losers to be able to offset the gain that I currently have. Now, of course, there are some tricks to that because you can only, obviously, if you have losses that are higher than your gains, you can only offset up to $3,000. I'll make another video on that as well because that gets a little tricky. But with tax laws, there's something called tax loss harvesting where I can use my losses to offset my gains. And that's another effective way to be able to lower how much I'm going to owe in taxes. So again, talk to a professional about that, about tax loss harvesting, so that they can look at your scenario to figure out if it's appropriate to do, because every scenario is different. But tax loss harvesting and using capital losses to offset your gains is also an effective strategy to be able to lower the taxes that you owe. Number four, which is probably one of my favorites because it gives me the best of both worlds, loan against your portfolio or loan against your assets, even if it were real estate. This is, man, I love this strategy. And again, this is more of what people will call risky because obviously your asset could decrease in value and scenarios could happen. But let's just talk about loaning against your actual portfolio or your asset. Why is this important? Well, here's the thing. Let's say that I have a ton of shares in Microsoft and I'm buying and holding, right? I don't want to sell my Microsoft shares, but I need cash, right? I need cash. But if I sell my Microsoft shares, I no longer own the assets. I no longer own that asset anymore. I don't own the stock, which means that it can't continue to grow if Microsoft continues to grow. And secondly, on top of that, I'm also going to have to pay capital gains tax, short term or long term. Short term if it's less than a year, long term if it's longer than 365 days. So but I need cash. It happens to us, right? Well, if you loan against your portfolio and you put your portfolio up as collateral now, it gives you the best of both worlds. What that means is now, okay, I can keep my shares in Microsoft intact. I don't have to sell them off. I can bypass the capital gains tax, short-term and long-term capital gains tax, because I'm technically not selling my shares. I'm loaning against that to get the cash that I need, while keeping my shares in place and bypassing the taxes at the same time. They can't tax me on a loan. The same way that if you were to go to a bank right now and the bank were to give you a $10,000 loan, you're not being taxed on receiving a $10,000 loan. It's a loan, right? Same concept here when it comes to your assets and your portfolio. Loaning against that now bypasses the taxes and it allows my asset to stay in place so that it can continue to grow. Now I can take the money that I just got loaned to me now, and I can use that to buy more income. So maybe I want to loan against my portfolio, and maybe I want to use that to buy real estate now. And now when I buy that real estate, I can use the actual rent roll from the real estate to pay back the loan. And now from there, I now have my asset of my stock portfolio still in place, and I have another asset of real estate at the same time. And I was able to do that without paying tax. Again, there is risk to that. Obviously, because if your portfolio were to take a dip and the value decreases, then it could offset that loan and you would end up having to pay it back immediately, or they would obviously your portfolio is collateral, is being held as collateral. So that's it. But when we talk about making more money, there's always going to be risk involved in making money. But obviously you want to do this manageable risk. And again, I always talk to a professional before doing anything. But these are things that I like to think about, because instead of me having to sell, if I can just loan against for a short period of time to buy more assets and pay it back with the income being produced from that asset that I just purchased from the loan, yo, that's a win-win. And I didn't have to pay taxes, man. Yo, I love it. And this happens in life insurance a lot too. And I talk about this when I talk about having a permanent life insurance policy, and how with your permanent insurance policy, with all the interest that you're earning through the cash value that you have in life insurance now, of how you can loan against your life insurance portfolio and do the same thing. Walt Disney, people don't know this crazy story before I move on. Walt Disney actually did that, and that's how Disneyland was created. He loaned against his life insurance policy, started Disneyland, because the banks would not give him a loan. So he had to do it through insurance. Same thing with your other assets, with your stock market portfolio or real estate, right? This is important. So that's a way that you're able to bypass taxes altogether, purchase an additional asset, and still keep everything intact. And number 5, last but not least, which is to me probably my favorite, you die with the stock. Die with it and pass it down to your family, man. Like, yo, that's real generational wealth right there. Hey, I'm not going to pay the tax because I died with it and I passed it down through a trust to my children, to my family, man. Now you done passed down the asset to your family, right? So you didn't have to pay the tax at all. So that's the most effective way to bypass the tax, create generational wealth for your family. Now, obviously, inheritance tax could come into play with that. Again, talk to a professional regarding that when passing this stock down to your family, because it could affect the cost basis. And there's a lot of other technical things you don't need to worry about. Just talk to a professional. But man, die with the stock, pass it down to your family. That is a beautiful thing. So with that being said, we talked about what is a capital gain, right? A capital gain occurs when you sell off an asset for more than what you sold it for. We talked about the formula of capital gain equals my sell price minus my purchase price. And then we talked about short-term and long-term capital gains tax. Of short-term is less than a year, ordinary income tax. Long-term is longer than a year, or over 365 days. Then we talked about the 5 ways that you can bypass and or lower your taxes, which is number 1, going through buying and holding for longer than a year, which will lower your capital gains tax, of course, so you're always in a long-term tax rate. We talked about investing through your retirement account. Preferably, I love Roth IRAs so that I don't have to pay any capital gains tax when I'm 59 and a half. We talked about tax loss harvesting, where you can sell off some of your losing assets against your winning assets, so it can lower your taxable, so it can lower your capital gains tax. We talked about loaning against your portfolio so that you can keep the asset intact, to bypass the tax altogether and use the loan to be able to purchase more assets to make more income for yourself. And then also we talked about just dying with the asset altogether and passing it down to your family, right? So all of these things, man, take these into account. Talk to a professional. Of course, if you need one, Jumping Jack Tax Franchise is here for you. Like I said, text info to 267-792-0185 and somebody on my team can help you. But I hope that this video was massively valuable to the beginner out there that's taking the steps of buying assets and buying some freedom. It's available for everybody, right? And you have opportunity to do it. And I hope this video empowers you to do that. With that said, I'm Prince Donnell, founder of the Jumping Jack Tax Franchise. Please be sure to watch a lot of my previous videos on YouTube. I have a ton on starting an LLC, how LLCs are taxed, LLC versus S Corp. I got a bunch of different videos on business when it comes to taxes and business finance. And share this, like, comment, and subscribe as well. If this was valuable to me, leave a comment below, a thoughtful one of what you thought about this video. And also share in the comments as well, what other videos would you like for me to talk about around the business financial field? And I would love to be able to bring a presentation for you guys. With that said, y'all have an amazing day. See you next video. Peace.